How has the week been? Who made
Fantastic,
money?
sir.
Who made money? Who did not make money? Let me know. If you don't make money, tell me. If you made money, tell me you made money.
I didn't make anything, sir. I didn't make money.
Did you trade?
Yes, I did.
So why you didn't make money? Why you didn't make money this week?
My analysis were off.
Which pair did you trade?
I think I traded EU.
You traded EU, you traded good. How come you didn't make money? If you traded EU, you traded good. This is EU. Right from on Monday, in fact, I literally told all of you, I didn't, it was just left for me to open my mouth and say everybody should sell. Because I didn't want to force anybody to take risk against news. But I did all I could, to analyze everything that will happen. Every of my expectation, everything. And I even told you guys that I was taking a risk on gold. I didn't just want to open the whole of my mouth. If not, I was taking risk on gold. I was selling euro dollar. I was selling pound dollar. I was selling AU. But I was moderating my risk on each of them. Even including, some of them I had already even reduced my risk because the market had moved away. Like gold, the market had moved away from my entry. All right? Right here. The market had moved away from my entry. And I said gold will come down. All of them will come down. And I already secured, a very little risk. So I literally told you what will happen on AUD, euro dollar against the news here. So where did you take a trade and you lost? Where did you lose? Where?
After CPI, I was trying to trade pullback, like a pullback setup.
There's no pullback setup. Here. If you say you want to trade pullback setup, okay. Number one, look at this. No, if you even say you want to take pullback setup, no problem. It's allowed. Look at this is structure, okay? But look at the mitigation. This is what you will have taken as mitigation. But if you are taking this as mitigation, excuse me, at this level, if the structure is correct, okay, let's say the timing is correct. But excuse me, sir, excuse me, ma, is the mitigation correct? Is the price correct for buy?
No.
Why?
No, sir.
Why?
It's not up to the fib level, 75 to 90%.
Good. And even if it's up to the fib level here, I always told you something. Look left. Do you have a inefficient price action there?
No, sir. They are all efficient, sir.
The reference move is clean.
They are efficient.
It's efficient. Sorry, it's not clean.
Yes, it's not clean. It's not efficient. So because of that, even if you have to take a buy trade, you must have to wait for development of another structure here. You have another structure here, good, and you have a reference move here. You have the demand leg is very clean, fantastic. You can now take a buy trade from here to the upside. This is the process. It's not difficult, you see. That's all. You cannot take it like this. But here, Mr. Vitus, here it is clear that you never had a clean push here. You never had a clean push here. Okay? But one thing that you can also do that will have been justifiable is this. Listen to me, everybody. Listen to me. If you have this move, you are having all these legs that are very efficient, and London, New York overlap came and make a boom to the upside. Okay, make a boom to the upside and return. Listen to me, and return to the level where it made that boom. Legitimately, structurally, price-wise, time, everything is right for you to buy here. Hello, everything is right for you to buy here. Why? Why will you buy there? Now listen to me, listen to me. Everything that happened here, very efficient. Agree with me? So which means that price, all the pricing that happened here is not known. It's known to both buyers and sellers, and there is nothing new in it again. But it is that this move created by London, New York overlap is the only most important demand leg in the whole of the move from here to here. That is the only important demand leg. And so we always take this to mean that as soon as you have that push, boom, at the beginning of New York, and you have liquidity right here, okay? So, and you have liquidity right here. When it returns immediately to that level, okay, you are no longer looking at what happens in all this structure here. They are all efficient. They are no longer new pricing. So all that concerns you right now is a move from the beginning of the demand here to this level. Why? Because that level is one most important level that was created by London, New York overlap. So what you have to do right now is to take your fee from that level upside. Okay, where is your 75 to 90? Right here. Good. And then where is your 27? Right here. You see it? Right here. So it's like these guys don't know our rule. They're just noisy. Huh? All right. So you see it here, but now I want to now shock you. If you now take it this way, you know, every of the setup I have taught you to be taking, you will discover that there is no way where market moves. There's no way you take it that market will not move away from there. Okay, like this one. Okay, this is the only level that is important in the whole of this structure, and that is where the mitigation stop. So, but I am saying that if supposing you have this clean price action, if it is here that you have it, then except you have convergency, that you stop here. If you don't have convergency, you shouldn't have stopped here. You have come to this leg that is here. But right now, at this point in time, every leg here that is supposed to be inefficient is efficient, and market has no business coming there. So we have to evoke this rule that this demand leg is emanating, this fine demand leg is emanating from London, New York overlap, and that is the only most important demand level. And so if you are going to take your fib, remember, you must take your fib from most important demand level. That's why you take your fib from here to here, and this is where you get in. And if you get in here, you are targeting this level. But what did I tell you? When the move that emanates from here refused to break this top and is coming down, what did I tell you? What happened to this leg? What happened to this demand?
It will be taken out.
What happened?
Why is it demand?
It's a weak
It will be
demand.
taken out.
It will be taken out, yes, because it is a weak demand. And once it is and once it is taken out, and already the market is in a downtrend. Remember, the market is in a downtrend. So we are expecting a pullback, but if this demand cannot create that pullback, you know that this market is not there ready for what? For any pullback. All this I'm explaining to you is price behavior. That is the behavior of price on any asset. Okay, I want to do a pullback. You have given me a mitigation of demand to ensure that pullback. But when you mitigate that demand for me, the demand is not possessing adequate volume to push the market to the upside. So, which means the asset is not telling you it's not ready for pullback. Are you going to force it to pullback? No. And then, as soon as you reach top here, you cannot sell here, because there is nothing to tell you here that this market will not continue to the upside. You can only begin to look for sell after this level that's supposed to push up the price to the upside has been invalidated. Once it has been invalidated like this, you are not looking for what? You are not looking for buy again. You are not looking for buy again. So when we come next week, if you see structure develop here, mitigate here, you sell more. You sell more. You sell more. It takes time. It takes time for the impact of FOMC, for the impact of CPI, FOMC, these two in particular. It takes time for the impact to wear out of the market. Why does it take time for the impact to wear out of the market? Because this is one of the biggest news that, investors look at in order to take investment decision. Particularly interest rate. All right. So that is how it is. This is price behavior. Price behavior. And you get to understand it.
Yes, sir.
Yes, sir.
Mr. Abitus. So this is how this thing is. This is how it is. You must understand. You must understand price behavior. It's very, very vital. It's very, very key. If you understand price behavior, you won't get into any trade that you are not supposed to get in. You won't. You won't. Understand session characteristics. Understand how different sessions, how they operate. Understand it. When you understand session characteristics, you understand price behavior, you understand your liquidity inducement, you understand trend analysis. You have to combine all this knowledge together to make decisions. I know it's a bit easier for me because I developed most of this system. It's more or less like a child's play for me. Maybe in every 10 analysis I do, maybe I make mistake in 1 or 2. All right? But you are not the developer of the system. You have come to learn how the system operates. So it's not going to be an easy passage for you guys. But with practice, you can even be better than myself with practice. And that is why I keep on, I'm making sure that every Friday I come online, show you things. In fact, sometimes even before it happens, I show you. Do you remember this? Do you remember this? This how to go. This how to go. I can't do more than that. I can't just do more than that. Because I believe if I'm showing you based on the available theory we have learned, I'm showing you things even before they happen. And it's happening the way I say it. Then you will know that the theory you have learned is real. But if I'm showing you this is what will happen, this is what will happen, and you are afraid to take the trade, you know that it's none of my business. Now you no one do. Now you no one make money. Now you no one rich. Okay? There is an opportunity for everybody to be rich. But if you decide not to be rich, it's none of my business. But I want to make sure that everybody understands how this thing works. Very simple, not difficult. You should master the game to such a level that in 10 trades that you analyze and take, you must win it. If I can do it, you can do it. Like me, after this massive win here, AUD USD, enter from here, massive win, okay, which I showed you before I enter. Good. After this drop here, from here, I think it's this one, from this side, drop here. I enter here again, drop here. I enter here again, drop here. But I will show you one analysis here before I go. And after AAU, literally everything, this one here, hit TP here, boom. Why do I have to trade for the week again? Why do I have to go in? Why do I have to open chart and say I want to trade? I want to trade for what? Excuse me, for what? To do what? You have made 100% of your account in one day. What are you doing? If you still go back, you are a greedy man and you deserve to lose all your account. You deserve so. I've made 134% of the account in just few setups. Okay, so that is it for Mr. Vitus. I think you understand the issue with your AUD now. You understand?
Yes,
you understand?
I understand.
Good. So assuming it's like this, if he wants to do a pullback, now everybody learn this lesson. You know, that is why even myself, I won't stop teaching. I won't stop teaching. Why I teach, I remember a lot of things that we need to take into cognizance, into consideration while we trade, and that also gets me more improvement day by day. Do you understand? Now, any market that want to pull back, remember I always told you that you always have two legs in a pullback environment. You have this first leg, you have this consolidation, you have this first leg as the reaction, you have the intention, and you have the what? Mitigation. What do I say is the characteristics of the intention in a pullback environment and the characteristics of reaction in a pullback environment? If anybody remembers, can the person help us out? I told you there is a characteristics. You can go ahead. What do I say is the characteristic of the second leg and the first leg in a pullback environment?
They are going to be clean, like they are going to be inefficient. Like you see,
Which one should be inefficient? Which one will be inefficient?
The reaction itself.
The reaction will be very efficient. Okay, the reaction will be very inefficient. Yeah. God bless you. Okay. What happened to the intention?
The intention could be efficient or inefficient. It just
good.
It depends.
Good. So you see, most of the time, somebody is noisy again. Most of the time, all right. So most of the time, if a market is in a pullback environment, I'm sorry if you are from a free group and you don't understand some of the things we discuss here. I'm so sorry. To go back and begin to explain them will not be easy. Okay, there is what is called pullback environment. Okay, and there is a setup that is associated with a pullback environment, and that setup comes with three elements. You have what is called the reaction, which is this one. You have the intention, which is this one, and you have this mitigation. Okay, and each of them have their own characteristics. In a pullback environment, the intention, the first leg, the reaction is always very strong and highly inefficient, because that is where the mitigation is coming, and mitigation needs the market need to mitigate at a level that is highly inefficient. That is the issue. So, but the second leg, which is the intention to buy in a pullback environment, may not even be strong, may not be inefficient. It may be anyhow. Sometimes it could even be very small like this. Just break structure a little and come down. Why is it coming down very fast? Because it's gathering liquidity here, it's gathering liquidity over there, and it's building up inducement over there. So because it's not able to push to the upside, it now has to come down and take all this inducement, mitigate the downside, mitigate demand for the purpose of the upside. Now, this description I have just given to a market in a pullback setup in a pullback environment, do you see it play out here? Look at this leg here, sir. Everybody, look at this leg here. Is it inefficient like you have here? You have it here. Rather, it is the second leg, which is the reaction, that is now what? Very inefficient. What happened to the leg here? If you want to pull back for me, why don't you, this second leg that is very clean here, why don't that one come to this leg here? So immediately that one failed to come to this level here, I knew that no. This is going to be a continuation pattern to the downside. Okay? It's going to be a continuation pattern to the downside. But because this leg was generated by London-New York overlap, if it comes back right down there, you can take the trade to the upside. But when it fails to break the upside, forget about it again. You are coming down. But even as we said you are coming down, you cannot still get involved in the coming down right here. You can't get involved. You can't get involved here. Why is it that you can't get involved? Because at this level, you never knew whether this upside will come or not. You never knew. So why must you get involved when you never knew? So allow this to now come. This one has now invalidated everything. So whatever structure you get here next week is what will determine whether we will buy or we will sell. Listen to me. Now, I'm taking you gradually to the realm of market sectionalization. You know, maybe I have not taught it, but if you get into my website, when it is launched, you will see market sectionalization. You see how we section the market. At this point now, you cannot tell me that next week AUD USD will continue to go down or it will continue to go up. We don't know. I don't know. I trade based on the section of the market, based on what the market present to me at that session. That is all. That is all. That is all. I don't want to know. This system I have developed here is evidence-based. It's based on evidence, based on data. If we come next week and I see push here, I see all this, I see this, I see this. Excuse me, why will I not buy here? Tell me. It then means that what Mr. Vitius wanted to do here is exactly what has come over here. And I'm going to buy here. I'm going to buy it. But if we come next week and instead of seeing something like this, and I begin to see and I see something like this upside, I see this, 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 I see this. What is this? What is this pattern called? What do we call it, guys? What do we call it?
Fake flag.
Fake flag.
God bless you. God bless you. This is a concept of fake flag formation. And it's a what? It's a continuation setup. It's a continuation setup. Why? Look at it. Look at here. This level. Is there demand here? Is there demand here on that leg? Is there demand there?
No demand.
No demand. Why is it that?
Demand.
Why is it that there is no demand? Why? Why?
Because there's no break of structure.
God bless you, because there is no break of structure. Therefore, there is no inducement here. And if there is no inducement right here, there is no liquidity below. And if there is no liquidity below, that demand level is fake. So now, if you now have break here, boom, to the downside, all you just need to do is to go on a confirmatory test. Okay? Just go there, look at your RSI. You have something like this. Can you see? Simple. Can you see? This guy is flowing to the downside, lower low, lower low, lower low here, and here on the indicator, what do you get? Lower low, lower low, lower low there. Okay, lower low, lower low, lower low here. So based on this, you now see that this market is developing a flag that people who are not knowledgeable about this market, they think is going to break to the upside. But we know what is happening. This is a fake flag. Okay, because we have broken the structure here, it will usually go back to what? 50%. Okay, and go down. Now, somebody will just see it, and when it gets to 50%, you want to slam sell. Boom. No. You have to go on your 3D analysis. 3D analysis. Thank you. 3D analysis. Structure, yes, done. Time, pricing, done. Once it gets to 50%, anything from 50%, the pricing is done. But time, what of time? What of if it gets to that 50%, brothers and sisters? What if it gets to 50% by 12 p.m. Nigeria time? Is the time element of your analysis correct?
No, sir.
No. So, which means that it is the tendency is there that this 50% you are looking forward to might push to 70% or 80% or 90%. If is that level that I want to sell, then time element will be correct. Okay, when market push to that place. So, if it is 2 p.m., 1 p.m., 1:30 p.m., 2 p.m., 2:30 p.m. that it pushed to 75. Is it not that time that time element is called of your analysis is correct?
Yes, sir. It is.
That is when you now get in. That is when you get in. It's as simple as that. You see, you will do some crazy analysis, very correct, fantastic. It is time. Excuse me, sir. It's time that will disqualify it. Time will disqualify it. And at the end of the day, you will now see reason why I instituted a three-dimensional approach to market analysis. You will see the reason. If you are conversant with what we do, and you are sensitive enough to how I do the analysis, you will discover that there are many trades that you will not be losing again. You are supposed to be losing if you are not informed, but you will not be losing them again. Why? Because you are conversant of timing, you are conversant of pricing, you are conversant of structure. These three elements must be present. Structurally, you must be correct. Price-wise, you must be correct. And you know our rules. Our rule here is simple. Before we buy, we must get a mitigation to a discounted level of 75 to 90. We do not respect your 61.8. Allow 61.8 to those who are not informed. And you will agree with me. Go and check all the mitigations that you see. Anyone that ends at 61.8 will not fly to the upside at that level. Yes. Do you understand now? So that is how it is, ladies and gentlemen. So another person, because I say bring your questions, bring your challenges. Any areas where you are a bit challenged, just let me know. Bring them to me. Let's solve the problem. That's the essence of this session. Of course, what you are supposed to do today, we have done it on Tuesday or so, which is three-dimensional approach to market analysis. Market analysis based on structure, based on timing, and based on pricing. But today is to help as many that are having one challenges or the other. Show me that area where you are challenged, and then let me now come in and see how I can help you in them. I'm waiting. Yeah, and if all of you don't have any area where you are challenged, we'll just close the meeting right away. All right.
Hello, sir.
Yeah.
Yeah, like the one that I sent on the group, on gold.
Yeah.
In 1 minute.
Yeah.
So I don't get your message very well. I didn't get it very well before. So
you did not read it very well now. I said, if we can go back to the message, we can go back to it. I think everybody's on Telegram now. Are we on Telegram? Are we on Telegram now?
Yes, sir.
Yes,
Yes,
sir.
sir. Yes, sir.
Okay. So, okay, sorry, not our own. Let's go to our discipline analysis masterclass. A second, please. I'll pause the video. Are we there? There. Hello, guys.
Yeah,
Are we there?
Yes, we are here, sir.
Okay.
Yes, sir.
So now, So I wrote this message. You see, I said, I want us to read it together. It's whenever I push a message across, please read it very well. Read this very well, okay? If you always listen to me very well, I always mention 1 to 2 hours of session opening. It's when you expect price to mitigate its level. If it's getting to 3 hours, then such mitigation is not to be trusted, except if news is released at that time, like FOMC. You know, FOMC is normally released at 7:30 Nigeria time, either 7 or 7:30 PM Nigeria time, okay? Which is ordinarily is off time. All right? But if news is released that time, what is the essence of mitigation? Is it not because of existence of volume during session opening that is causing that upsurge in the move that result to that mitigation? So if you are releasing FOMC by 7:30, then you should know that that volume will come by that time. So any mitigation that comes that time is a valid one. That is why when I create a rule, when I create a theory, I create an exception for it, because everything is based on assumption. If this is like this, this is what will happen. If this is like this is what will happen. If this is like this, I know, even me, I know. It takes somebody average of 6 months to 1 year to totally master everything I talk about. And it takes consistent followership for you to master it. See, let me tell you, if you are a type that is not following me bumper to bumper, you are not following me week in, week out, I swear you won't get anything from whatever I teach you. If you come 2 weeks, you run away 1 month. You come 2 weeks, you run away, forget it. You can't get anything. But for those who are consistent follower, you can see that before, when I ask questions, it's difficult for people to answer me. I will get angry. But today, there's virtually no question I ask. As long as those guys in the mentorship community are there, there is virtually no question I ask about theoretical framework of the market that you guys will not answer me. It starts from there. It starts from there. That alone shows that if you go out, if you go to anywhere in the world, United States, UK, China, Japan, Brazil, you go to anywhere, you can talk of the market. That is one thing that is guaranteed for you. You can talk of the market. The next stage will now be, how do you now translate this information you have about the market to what? To money. To money. How do you break that barrier? How do you break that imaginary line between theory and practice? That is where the understanding of market price behavior comes in. No, if you are a professor of market analysis, okay, and you don't understand price behavior, I swear to God, who created me, you will not withdraw in this market. I discover all this on time. I discover them on time. You must understand price behavior and match it up with the theory of the market. Match it up with everything. You remember I told you in the last session that most of you are doing one-dimensional approach to market analysis. Only structure. You are doing only structure. Nobody anywhere, I've not seen anybody anywhere in the world that does market analysis with only market structure and succeed. It's not in this 21st century. Why? Because market in itself has become complex. Market has gone complex. It's no longer as simple as before. So because of the complexity of the market, understanding market structure alone is grossly inadequate to what? To have a consistent profit in the market. You must understand other elements with it. Three-dimensional approach. When we are done with three-dimensional approach, you understand it. I will now take you to 5D, analyzing the market in 5D. 5D. You have 3Ds, you have 5D. Okay? Once you understand this 3D, it's enough for you to make money. But you want to take your trading to the next level, you have to understand 5D. 2Ds will be, 2 dimensions will be added to those structure, time, and pricing. You are going to add technical indicator and economic indicator. Once you know this, honestly, you can trade for JP Morgan. You can trade for Morgan Stanley if you know market analysis in 5 dimensions. But we are even talking to people who are still doing it on 1 dimension. 1 dimension. You are on 1 dimension. And you can't make money with 1 dimension. Okay? You can't. You can't. It has to be on 3 dimensions. That is the least requirement for you to make money. But I tell you, I don't even operate at 3 dimensions. I operate at 5 dimensions. I will now add technical indicator and then add economic indicator. Those are the 2 things that will be added to the other 3. Once I add it, the essence of technical indicator and economic indicator is to give you, is to test the 3D that you have. Test it with these 2Ds. Are they in compliance? Once they are in compliance, nothing will make you to fail the setup. Nothing. Nothing will make you to fail the setup. That's why I throw whatever idea I have, I throw it to you. This will happen. This will happen. This will happen. You will see a lot of setup. Okay? Because an app is coming that will be essentially devoted for setup. I will use that group to practice before that one will come. I will give you a lot of trade. Just get prepared. A lot of setup for you to take prior to the launching of that trade setup app. You get the logic now? So that is it, guy. So guy, mitigations happen 1 to 2 hours in of session open, because that is where the liquidity is the biggest. Okay, and I respect mitigation that happens in London, New York overlap, because global market transaction is always at its peak, and you cannot have it at a better time than that. Okay, somebody sent question to the chat group. to the chart section. He said, Lakunle chart said the major area I have issue is how to connect the time frame. I analyze on 15 minutes, but picking a trade on another time frame is a little difficult. And when I pick a trade on 15 minutes, it takes time before hitting TP. How do I connect my analysis time frame to my entry time frame? Yes, you have asked a critical question, but fortunately, this question you ask now there is a ready-made answer in the mentorship program. So if I now begin to this question you have just asked is a whole session program. Okay, if I have to start explaining, it's a whole session. All right, I've told you guys in the last training we had, there is nothing like time frame analysis. You can decide to say you want to trade 15 minutes time frame. All right, okay, and the condition that will make you to need, that's just the only thing I will tell you guys. Let me just close this. How do we know valid mitigation? Okay, that's the only thing I'm going to tell you. That's the only thing I'm going to tell you. Okay, you need one time frame to trade. One time frame to trade. Compulsively, you need one time frame. But there are situations that will warrant you to need the second time frame. Okay, so based on this, we will say here that you will need, let's just say you need 2 time frame. Okay, 2 time frame. One is analysis time frame, and number 2 is entry time frame. All right, so before I now proceed further, I want to now ask you a question. All right, if market is like this and you want to buy here, if you go to 4 hours time frame, does the price change? Does the price change here? If you go to 15 minutes time frame, does your change of time frame, does it change the price?
No, it doesn't.
If you go to 1 minute time frame, does it change the price?
No, sir.
But I want to ask you a question now. It's a challenge. What do you think will make you to know, when you choose a particular time frame, what will make you to know that the pricing that you are getting on that time frame is the best pricing? If it is a buy that is the heaviest discount you can get in the market, what will make you to know?
Price getting to 75 to 90.
That is the mitigation. That is the genuine original mitigation at that level of 75 to 90. Is it not what will make you to know that you are having the best price?
Yes, that is it, sir.
So if you are analyzing on a time frame and you are getting your mitigation at 75 to 90, have you not gotten what you want?
Yeah.
So why doing multi-time frame analysis? It is senseless, and if not for me not want to sound immodest, I would say it is idiotic. But I don't want to sound immodest. You have gotten the best price you want in the market based on your analysis time frame. So what is your business stepping it down to another time frame, looking for what does not concern you? Why are you looking for what does not concern you? Why? What's your business? But remember, I told you that you have analysis time frame, you have entry time frame. Your analysis time frame, your entry time frame is needed only and if only you are mitigating at a level that is inefficient. That is efficient rather. For instance, look at this leg here. Here, supposing price action is efficient here, and you now mitigate this level, I can bet it with my life account that this market will not push to the upside. Why? The price that the mitigation is happening is a known price. It's no longer new. Because there was agreement between buyers and sellers when price was at that level. So it's a price that is known to everybody. So when market mitigate that level, why are we in a hurry to buy? We are not in a hurry. You must therefore, it's disturbing me. You must therefore look for another another efficiency. Since this place is efficient, you must look for inefficiency. Because let me tell you something. We do not benefit from a perfect market. What do I say? We do not benefit from a perfect market. What is a perfect market? A perfect market is a market where you have many buyers and many sellers.
Wow.
A perfect market is a market where you have many buyers and many sellers. And when you have many buyers, it means that there are a lot of people who are coming to buy. And then when you have many sellers, there are a lot of people who have supply. When you get to the market, you just buy and go. When you come to the market, you just sell and go. You don't face difficulty in buying and selling. So the price for such market is usually stable. It's always stable. When market has a price that is stable, do you benefit from it? Do you benefit?
No, sir.
But when you have a market that is skewed in one direction, maybe you have many sellers who have come to the market, but no buyer. What happened? The market will just stay down, nobody to buy. What happened to the price?
Price will go down, sir.
Price will crash down. This is what creates inefficiency in market, and that is what we want. If there is no inefficiency in market, we are not going to benefit. So we always look for that inefficiency. Whenever market is perfect, we cry. Why do we cry? Oh, it's not only we that cry. Go to the market. Go to my 12th market in Lagos. When there are a lot of buyers, a lot of sellers, what happened to price? Price will be stable. There will be agreement on price. And when there is agreement on price, it does not benefit us. We want a disagreement in price. We want to use their head to knock themselves. We want to create a situation of scarcity so that market will become inefficient. And it is when market is inefficient that we look forward to making price to rebalance, to bring itself back to the level of inefficiency so that market can correct itself. We can take advantage from there and buy. So in that case, when market now mitigate this level that is very efficient here, we now seek for market to create a structure, okay, in which a leg is what? A leg here is inefficient. So when mitigation now come to that leg that is inefficient, we now take the price to the upside. Boom. It's as simple as that. Boom. Boom. This is it, guys. So the guy that asked that question, I know you are not in the mentorship program, so but this is how far I can go to explain, efficiency and inefficiency for you, and how mitigation takes place. You also asked how do you know correct mitigation? There are conditions that define mitigation that is genuine or that is not genuine. An incorrect mitigation will always have inducement, but you don't know inducement. So how do you know this? So that's the problem. There are a lot of things that you need to know before you even get to theory of mitigation. But if you don't know those things, how do you understand what I'm saying? But I just have a lot of pity for some of you guys in the free group. Occasionally I will extend my session to you, but my problem is, how do you understand what I talk about here? How do you get it? Because there are things that you ought to have gone through before you can understand when I speak. There are a lot of Forex forum that I go that when I speak, they don't understand me. They won't understand. How would they get what I'm saying? Because the background theory that explain what I talk about, they don't know. They don't know. Okay? Because they are stuck with the conventional method of analysis that never worked, that is sponsored by the brokers. If I tell you some of the secrets, all of you will be shocked. Sponsored by brokers to give you that enablement to click your trade, pam, 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 for them to make their commission. They don't work. They don't work. Do you understand now? So, any other question? Any other question? Another question? Any other question? I say bring your questions, let's answer them. And in the process, then now, yeah.
Hello, sir. Sir,
Yeah.
before CPI, you gave some explanations to why the market is going to crash.
Yes.
But structurally, there was no. It was not. I could not get it structurally. You understand? But you
Okay.
used fundamental analysis to analyze the market, and then it went the way you analyzed it.
Yes.
So I don't know if you can just shed some light on that area.
Okay, no problem. I'm going to do that. What news was released that Tuesday, right?
CPI, Consumer Price Index.
Consumer Price Index. Okay, look at it. We have CPI here. CPI. This is what is called a leading indicator. Under my course, under fundamental analysis, I think that is one of the updates I'm going to do. We have leading economic indicator. Okay, CPI is a leading economic indicator. What do you mean by CPI? CPI is Consumer Price Index. Somebody is noisy again. Who is this person? Akinton, you are noisy, right? Okay, so Consumer Price Index just measures, changes of, consumer prices over a period of 1 month. That's just it. We want to look at the items that consumers always demand for on a daily basis, like rice, like tomato, like groundnut oil, like Maggi, like Gari, like beans, like Indomie, like soap, like this, like that. We want to see how prices has increased over a period of 30 days. Is price increasing? Is price reducing? We want to know. Okay? So if prices are going up, it's a signal that what? Inflation is what? Is going up. Do you understand me now? If prices are coming down, it's a signal that inflation is coming down. If CPI is up, it means that inflation is up. If CPI is down, it means that inflation is down. And if it is up, then we are going to require, if CPI is up, which means that inflation will go up, we will now require the central bank of that country to increase interest rate. Because why are prices going up outside? Is it not because there is money outside? Is it not because people are earning income? There's money now. That's why prices are going up. Okay? So it will now be the job of the monetary authority of that country, which is the central bank of that country, to what? To adjust the excess supply of money to the economy. And one of the ways by which they can do this is by increasing interest rates. Once they increase interest rate, they will mop up excess supply in the system, and then inflation will go down. So, but what concerns us now is what is the effect of increasing interest rate on the currency? Is it not, if they increase interest rate, will everybody not look for the money and go and deposit it to earn higher interest? Do you understand? Is it not a currency that people are looking for that we appreciate? Is that not? Good. When you are looking for it, we appreciate. So which means that currency that have higher CPI, we have higher inflation. If you have higher inflation, they are likely going to increase the interest rate. And if they increase interest rate, the currency will appreciate. That is it. But the question now is that you must know whether CPI is increasing or is reducing first, before you know what will happen to inflation and interest rate, for you to know whether your currency will appreciate or depreciate. But now, this thing I'm telling you is you need to, I don't know, you need to just, if you're an economist, it becomes a little bit easier, but you will get it, don't worry. But now, I was saying the analysis that Forex Factory is saying that CPI will reduce from 0.4 to 0.3. But Nathaniel said, no, it's a lie. It cannot drop. It will increase. And I based my analysis on increase in CPI. How did I come about increase in CPI? Now, listen to me very well. Let's go there. Now, what are those things? What are those things that will make CPI to increase? What happened to the last job report that was released? Job report, NFP. Is it not positive? They are expecting from, let's say, from 200K, they are expecting 220K. They now get 303K. Abi? 303K. It beat their expectation. It beat their imagination. Is that correct? Is that correct now? Is that correct?
Yes, sir. Yes, sir.
Sir, yes, sir.
Now that you have a positive NFP, good. What will now, how does this positive NFP, how do we use it to know what will happen to the next CPI that will be released? If there is positive NFP, it means that almost many people are employed. More people are employed in the economy. Is that not? And not only that there was positive NFP, there was always a reduction in what? In unemployment rate, which means that American economy is doing fine and people are working. If people are working, if more people are working, what does it mean? What does it mean to the income level of the citizen? What does it mean?
More income for the citizens.
More income for the citizens. So if there is more income for the citizens, what will happen to the consumption of the citizens? Would they not buy things? Would they not consume more goods and services?
They will, sir.
Yes. So when they now consume more goods and services, that alone means that there will be increase in prices, because as there are any more income, it means that money supply will have increased. It means that there is higher money supply in the economy, and higher money supply is a signal to inflation. So with that alone, with the increase in consumption level as a result of increase in income, we already knew that based on that, okay, CPI, which measure how prices are increasing, cannot go down. It has to go up. It is on this basis that I said CPI will go up. It will not come down. And then what is the implication of CPI going up? It means that inflation will go up. And if inflation goes up, what will now happen to the next FOMC that determine rate decision? What would they now do? They will increase interest. When they increase interest rate of dollar, what will happen to dollar? Will it strengthen or it will weaken?
It will strengthen, sir.
That is where I derive my analysis, that since I'm expecting because of the job data, I'm expecting income level to increase, and because income level will increase, I expect consumption to increase. Because consumption level is increasing, I expect what? Prices of goods and services to go up. And because of that, CPI that measure how prices are going up or coming down must increase. And if CPI increase, it means inflation will increase. If inflation will increase, what happened to interest rate? They will raise interest rate. What happens if they raise interest rate? Your currency will appreciate. So since DXY is going to be bullish, I now expect all the major to fall. Yes,
fantastic. Wow.
I now expect all the majors to fall. And I was so confident of what I was saying. That was why I pushed out the analysis to the mentorship group, and I showed you that based on that analysis, I had sold gold. I only told you of gold. I sold gold, I sold AUD USD, I sold Euro USD, I sold GBP, I sold everything. Sold everything. And what happened? Within 5 minutes of the release of that news, most of the trade hit the TP. And I showed you. That is when you add fundamental indicator to your analysis. That is another dimension.
As a 5D, sir.
Yes. When you add technical indicator and you now add fundamental, economic fundamental or economic indicator, when you add these two to the 3 dimensions that you already know, then you are operating at 5D. When you operate at 5D, you are invisible. You are invisible. You can see how I demonstrated it to you. And all those things I was doing, I was on the road. I was not even on the system. That is how it works. You have to find a way to operate on 5D. But right now, work on the 3D. Once you perfect your 3 dimension, add the remaining 2 dimensions. Once you add the remaining 2 dimensions, then you are operating at 5D. will be invisible. All right. So this is how. This is just one. This is just a piecemeal. This is just one of fundamental analysis. Just one of fundamental analysis that you just have to learn. Just have to learn. Is I don't know how to explain it, but it's just basic economics. But when you now understand it and how it works, you now literally know how this market function. You now know that technical analysis is just like 10%. Okay, just let's say 20%. Technical analysis is 20%. Price analysis, price behavior is even more important than technical analysis. Let me tell you, there are times that your structure is correct. Your structure is correct. Your pricing is correct. Your timing is wrong. If you go into that trade, you are in trouble. Time. So everything has to be correct. Your structure must be correct. Your timing must be correct. And your pricing must be correct, must be right for you to be able to go in. But when you want to operate at a higher level, at an invisible level, you now add economic indicator and technical indicator. Right now, most of the guys in the mentorship group, they know how to apply the technical indicator. All right, especially when they want to do trend analysis. When you are doing trend analysis and you have to introduce divergence theory, divergency and convergency, you know how to apply this to your setup. All right, but the economic indicator must align. If all these things is saying that market will bearish, you are having a bearish setup, you must check what is the economy talking about concerning the currency that you are analyzing. Does it support your proposition that this setup is going to be bearish? If it don't support it, then you are good to go. You are good to go. You are good to go. So seamless, guys. Any other question?
Quick one, sir.
All right.
Is it every time you are trying to use technical analysis for your before you must add fundamental, or you can base on technical analysis without fundamental, or is it?
Yes, that's why I told you. I just mentioned 5D for you, but I told you that you can operate at 3D and you make money and you become a successful trader. It's not a must that you operate at 5D. Okay, the only implication is that if you are not operating at 5D, it means that you are not using economic indicator. Okay, you are not using economic indicator, technical indicator. You are only using doing your analysis on 3 dimensions based on structure, based on time, and based on pricing. You will be successful with that, which means that anytime news is coming, you run away. You have to run away because you are not operating at 5D. You run away. You close your MT4. Yeah, that's what I'm saying. But if you are operating at 5D, you don't need to run away when news is coming. You trade when news is coming, and you don't blow your account because you understand what the news is talking about. When they say unemployment claim, for instance, unemployment claim is released by Department of Labor of United States of America, and it is essentially for those who are applying for unemployment claim for the first time in their life over a period of 7 days. So if this number increase more than the expected level, it means that more people are filing for unemployment claim, which is bad for currency. Then you know that the currency will weaken. Then you position yourself to sell off the currency. It's as simple as that. And then if you want to sell the currency, if there is no mitigation for you to sell, will you sell? You have to wait. If mitigation of technical now align with the technical indicator for sell, you are seeing maybe a hidden bearish divergence, which is supported by technical. You are now seeing that economy indicator is saying you should sell from the top there. So you are operating at a full 5D. You can sell off, and then you see that you have no wrong. Is that okay? Please, now
I want to leave for you to try and.
I'm hearing you. Who is talking? Is the person talking to us or not?
So, and sir,
Yeah.
Akiton, sir.
Okay.
Concerning the lecture you gave on divergence,
Okay.
this hidden bullish divergence or hidden bearish divergence, I learned that on your RSI, there are times when you are trying to compare the trend lines on the chart and RSI.
The trend line or the trend line or the price on the chart.
No. On the chart, sir.
Okay.
When you are explaining the hidden bullish divergence,
okay,
the trend lines you draw on the chart to compare what is happening on the RSI.
Okay.
There are times on the RSI you draw the lower high at the top, and there are place you draw it on the bottom. Is there anywhere you can put it on the RSI, or there must be a particular place when you wanted to put out the direction the market wanted to go?
Yes, it's because you don't understand what we are talking about now. That's why you think we don't just do it anyhow. If we are looking for hidden bullish divergence, what you are saying now is that like you see this level here. You see this level here. Okay? You can see that this thing is to the upside now. Okay? But look at this level here. Is it not higher than this level?
Yes.
But look at indicator. Look at what it's telling you. What is it telling you? What is it telling you? This price here that is higher than this level, is it higher than it or is lower than it on the indicator?
It's lower.
It's lower. Price has been pushed lower. So what this thing is telling you is that even though price is higher here, those that are buying here, this move is what they got. You that is buying here, you are going to get a greater move times 2 of these people that bought here. That's why this price has pushed lower here. This is what is called hidden bullish divergence. We draw this one down here. But when we are checking when we are checking for either convergence or divergence here, we don't do it like that. Okay?
Yes.
Can you see this one?
Yes, I can see.
This one is higher here, higher than this, and you see that this one is higher than this. Okay, this is higher here, higher here. This is convergency. Is that not? This is convergency, and because it's convergency, my guys, they already know what to do. They know that this inducement will not be taken. Market comes here and will push to the upside. Simple. Okay. So I guess this is what we are saying. Why do we draw some at the top, and why do we draw some at the bottom? Is that not what we are talking about?
Yes, sir. Yes, sir.
So you have to go back to the video and see when we are talking of convergence. You have to draw it at the top. You are comparing the top. When you are checking divergence, you are also comparing the top. For instance, if this one, let's say you have something like this, up, and then maybe this leg is not so strong. And then you want to check if you see this and you see this. So this one is up, down, higher here, lower high here. This is what divergence, and we have drawn it at the top. But when you want to check a hidden bullish divergence, you draw it at the bottom. It's as simple as that. Do you understand? But if you want to check bearish hidden divergence, like here. Okay, if you have this and you have this, so you have down here, you have lower low here, you have down here, you have higher low here. Can you see? This market must push up to break this top. Simple before it can sell. That is. Go back to the video, my friend. Go back to the video. It's simple. This is the most simplest trend analysis. Is the most simplest thing we have discussed. The simplest theory ever. Am I lying? With divergence theory, go back to the video. Okay, somebody send message. What did you say? Mentorship. You dish out so much. We will still make the mentorship someday soon. I remodeled my trade checklist after the last class on the 3-dimensional approach. back test, and I saw the difference. Thank you, sir. God will reward you. All right, guys. All right, guys. All right, guys. Twali. Nasu. It's as simple as that. Once you follow it, your trade must, your trading style and everything must change. Okay. Make use of the opportunities you have when I am available to teach you, because I don't teach you trash. I teach you reality. Now reality I dey teach. Follow it. Now we don't say more than that. Everything I've put together here, nobody can come and say that this is my work. This is a lie. It's not anybody's work. I research on my own to put them together. Nobody can come and say it's his work here and there. I don't follow anybody. I've not watched single ICT video. They say people are called ICT. I've not watched single of their video. They say some are called smart money concept. I've not watched single video from them. I have not watched. So I follow what I decided. I'm not following anybody. The people that say I've watched their video very well is Elliott Wave Theory, and then I've 80% of the work put together by Mr. Elliott is wrong. Cannot work in this modern market. Can't work again. Okay, so I'm literally doing some work to develop a new wave theory methodology, a new approach to wave theory methodology to help those who are still applying what Mr. Elliott did 1930, 1960, 1950. They are still following what the man did when there was no CNN, no Facebook, no Instagram, no X, nothing like that time. They are still following when there was no information dissemination, improvement, and efficiency. They are still following what he did that time. That time trend was doing very well. Is trend doing very well now? There's complex situations now. So complex situation require complex measure for you to get a better result. Is that okay now? So you cannot analyze market in this century with the knowledge of 2 centuries ago. It will not work. It will not work. Is that okay now? Another question, guys. Olakunle Chat, do you get the logic now? Do you get the logic now?
Yes, sir. Thank you very much. I got it.
All right. Are you a brother to Abiola Olakunle?
No, sir.
But you know him.
Yes.
Oh, that's good. My regard to him. I hope he's fine.
Yes, sir, he is. He's fine.
Okay. All right. So another question, guys. All right. So because there is no other question, we have to call it a wrap at this level. So see you next week Friday.